All right, welcome to The Explainer. Today, we're going to break down exactly how a military conflict in the Middle East can send tremors across the entire global economy. And boom, it all kicks off with a massive escalation, a statement that grabs the world's attention and sends immediate shockwaves through the financial markets. So, to really get a handle on this, we're going to walk through the entire chain reaction. We'll start with the initial event, look at the economic aftershocks, and then explore what could possibly come next. Okay, let's dive right in. So what exactly happened here? The first move was this coordinated strike, U.S. and Israeli forces hitting targets inside Iran, calling it Operation Epic Fury. Israel then quickly confirmed its own role, giving their mission the name Lion's Roar. And, as you'd expect, the response was swift. Iran retaliated, launching missiles at targets in northern Israel and at American military bases in the region. So that's the event. But the big question is, how does something happening in one corner of the world manage to shake everything up? Well, it's kind of like throwing a huge rock into a pond. That first splash is the conflict itself, but then you get these ripples that just keep spreading out, touching everything from the price you pay for gas to the value of your savings. And that first, and maybe most powerful ripple, smacks right into the global energy market. Any conflict in this region is an immediate, direct threat to the world's oil supply. And to get why this is such a massive deal, you only need to remember one number: 20%. Think about that. A full fifth of the entire planet's petroleum supply has to squeeze through this one tiny, narrow waterway, the Strait of Hormuz. It is the very definition of a global energy choke point. And what's really wild is just looking at the scale of the facilities that are suddenly at risk. You've got Iran's main export terminal, Karg Island, pumping out something like 3 million barrels a day. But then, right across the water, you have this behemoth, the Saudi facility at Ab Kuwait, which can process up to 7 million barrels. And the scary part? We already know it's a target. It got hit back in 2019. And this chart, it just perfectly lays out who feels the heat first. Look at that. China is, by a huge margin, the biggest customer here, buying a massive 80% of Iran's oil. So you can see how any little disruption in that flow is going to hit the Chinese economy and hit it hard. Okay, so that's oil. Let's follow that next ripple out. Because when big-time investors get spooked, they don't just wait around. They move their money, and they move it fast. And we can see exactly where it's all going. What we see is this huge shift, almost overnight, away from what we call risk assets, things like stocks that can have great returns but are also super volatile, and into safe haven assets. It's basically a financial bomb shelter. When things get crazy, investors run for cover, and they pile into things that are seen as stable, solid stores of value. We're talking gold, the US dollar, and the Swiss franc. And you can see this playing out in real time, right now. The classic safe havens, they're doing exactly what you'd expect. Gold is up a whopping 22%. But what's really fascinating here is what's happening with the newer stuff. For years, people have been saying Bitcoin could be digital gold. Well, in this crisis, it's not acting like a safe haven at all. In fact, it's down over 25%, a huge drop. So we know there's a lot of anxiety out there, but how can we actually measure it? Is there a way to put a number on all this fear? Well, yeah, there is. It's called the VIX, the Volatility Index. But pretty much everyone on Wall Street just calls it the fear gauge. And that's exactly what it is. See, it doesn't track stock prices themselves. It tracks how much people expect prices to swing around over the next month. So when the VIX goes up, it means investors are buckling up for a really bumpy ride. And right now, that fear gauge has shot up by about a third just this year. That's not a small move. That is a major spike. And it's telling us that the market is expecting some serious turbulence ahead. And the technical charts, they're basically screaming the same thing. Look at this. All the different indicators that analysts use to track the VIX are flashing this incredibly rare, unified, strong buy signal. That's Wall Street jargon, but what it really means is batten down the hatches, a storm is coming. Okay, so this all leads us to the billion-dollar question, right? What happens next? Well, the good news is we don't just have to guess. Economists have already been modeling this, and they've laid out 3 possible paths this whole thing could take. Oxford Economics has put together these 3 distinct scenarios. On one end, you have a mild shock, which is mostly just about tougher sanctions. Then you've got a moderate shock, where all of Iran's oil exports get shut down. And then you have the severe shock. That's the one nobody wants to see happen.
So, in that first milder scenario, where it's mostly about sanctions, they're predicting the price of Brent crude oil would probably land somewhere around $75 a barrel. Now, that's up for sure, but it's probably something the global economy can handle.
But in that moderate scenario, things start to get a lot more serious. If Iran's exports are taken completely offline, you're looking at a jump to $90 a barrel, a much bigger deal. And then there's the severe one. If the Strait of Hormuz is completely closed, oil could absolutely skyrocket to $130 a barrel. A price like that, well, that would be a massive blow to the global economy. We'd likely see growth slow way down and inflation shoot way up. Now, it's really important to add some context from history here. We have precedent, right? We can look back at events like the 12-Day War in 2025. And what that showed us is that these oil price spikes from regional conflicts, they're often super sharp, but they can also be temporary. And that really leaves us with the final critical question, the one on everyone's mind. History tells us that this kind of shock tends to be brief. But with the global economy already walking on a tightrope, is this time different?